So I think we're recording. Let me just double. Yes, we are. So thank you for joining us today. Just wanted to say briefly again about the Southwest Angel Network, though I think Trevor and you and Dick and Chris know about us already. But so I won't say a whole lot. But I would say on the right side that we now have 52 angels, which is one more than we had yesterday. And we've now invested 5.8 million, which is 300K more than we had invested a week ago. So we're excited about our momentum, and we're excited to have our Dallas friends join us today. So we're going to talk about the stages of investing. And this is an introduction, 201. What happens with investments over time? Why build a portfolio? And how do you think about companies before you decide to invest? And I would encourage all of you to jump in with questions as we go along. Chris and Dick and Trevor, because Juan and I get energy from questions, not from talking to a screen. So. Juan, you may want to introduce yourself briefly here. You're muted, I guess, Juan.
Oh, I'm sorry, I had to step away. I don't have cat problem, I have a dog problem, so I had to let the dog out of my office. What did you say?
Maybe briefly introduce yourself.
Oh, thank you. So my name is Juan Thurman. I'm a director here at Southwest Angel Network. I had a career about 20 years or so in high-tech sales, mostly software and SaaS, startups, and very large companies as well. I've been investing for almost 5 years now. My focus is in impact investing and platform technologies.
Thank you. So, I may be preaching to the choir here, so I apologize. But, typical life of a company is they start off bootstrapping, meaning they're racking up charges on their personal credit cards or using life savings. And then often they'll go next to friends and family. Maybe they'll raise $20,000, $30,000. And that can be a good start for the company to have a little bit of capital. It also can be very awkward at Thanksgiving if you have to tell your family you've lost it all. So there's some downsides with taking money from the family. There are some approaches to raise money that are not in the mainstream investment path: crowdfunding, Kickstarters, and government grants. But angels typically come in when companies are raising anywhere from $250,000 to maybe $1.5 million or $2 million. And
okay,
then,
so homeowners.
I'm sorry. And then venture capital typically comes in when the numbers are in the millions of dollars. And if you're a unicorn in the Bay Area, like Uber, you may be raising $1 billion eventually. Alternatively, there can be strategic investors. These are large companies who like your technology, have a sales force that could sell your technology, and want to be close to the company and have maybe a right of first refusal to acquire you. And they also may invest at these $1 million numbers. And then, of course, all these investments are not liquid. The investors can't get their money back until there's an exit. Exit can happen with an IPO or a merger and acquisition or private equity. Sometimes private equities will come in and buy a portion of a company. So, that's how it goes. And we fit in here in sort of the middle of this chart. So, okay, sometimes investors will say, hey, I don't do impact investing because you don't make real money impact investing. We don't believe that impact investing is concessionary. You look at Kport Capital, who's a really large impact fund, their internal rate of return compares very nicely to that of other organizations, PitchBook and Cambridge Analytics. Not Cambridge Analytics, but Cambridge. And so, if you have the right kind of investments as an impact investor, you can make good returns. Juan, do you have some comments here?
Yeah, I think this was a bigger problem early on as we started the Angel Network, and it's becoming less so. I think now people are recognizing that there's significant value in investing in companies with a impact-driven mission.
Thank you. So what happens as an angel investor? Well, let me just assure you that early stage investing is risky in terms of these are companies who don't have maybe final products in the marketplace. They don't have established sales relationships with customers. They have all sorts of competitors surrounding them. And we expect that a large number of these, maybe 50% of these, may fail. But so what we do is we make, as angel investors, we develop a portfolio of investments. And we might make 10 investments of equal size. Then we expect a few of these to make a total return for us. So our aggregate IRR is positive. So typically with 10 investments, maybe 5 will fail outright, 1 will do really well, and the others will kind of survive. So the message is, think about, if you want to do angel investing, of building a portfolio, getting some diversity of companies into your investment stream. And here's a little more data that supports that. So the bottom of this chart shows cash on cash return. So if I've invested $1 and gotten $2 back in aggregate, I have a 2x cash on cash return. And then what's the probability of getting those returns based on the number of companies? And I arbitrarily drew a line across here at 75%, saying that, if you've invested in only 5 companies, likely you'll get 40 cents back on your dollar total invested. If I've invested in 25, I'm likely to get $1.40 back on my dollar. So, the goal really is to have more than 10. 20 is a better number. Questions, comments?
I have a question.
Yes.
What is the typical IRR that that you guys are trying to aim at, like floor percentage?
That's a great question. And I would say that personally, I don't have a number in mind. And what I'm really concerned about is whether the company is going to be successful. So, angel investing in my mind is all about risk assessment. You look at the risk of the technology, the team, the market, the competitors, and trying to find those companies which have a chance of being a really successful company. If you fund those that can be really successful, the IRR takes care of itself. And
I think that's really well said, Bob. If I could just chime in, I love sports analogies. It's kind of like asking, a football team, how many points do you hope to score? They kind of don't know, right? The score is going to be the score. As Bob said, what we're trying to do is find companies who might grow and have the capability of returning 4, 5, 6, 8, 9x our initial investment. And that's the trick, is to finding those kind of companies. And the IRR is going to be determined by things that are really largely out of our control, like how much of the company is sold to follow-on investors after we are involved, that sort of things. And what does the market look like? 6 or 7
right?
years?
So the return takes 2 years versus 5 years. With the same dollar paying out, the IRR is much different also.
That's right.
Hey, Bob, Dick here. I have a quick question. Most of the perspective here is equity investing, right? Not debt.
It's convertible debt, which is a form of future equity, but we have not done much in terms of just one conventional loan to a company, and actually worked out well. But it is all either debt that converts into equity or equity itself.
Okay, thank you.
Great question. Keep the questions coming, please. So the typical time for an exit, or sadly going out of business, going out of business tends to peak in the second and third year. And then if they can make it that far, they have a much better chance of surviving. The typical returns for exits take longer. So you can see here on the chart, greater than 60 months is a more typical time period. So the other message, if you want to be an angel investor, is if you need the cash in 2 years, put it into some other kind of investment than startup companies. You need to think about what portion of your assets you can be a patient investor with. Questions, comments? And You know, you may think that these companies need a lot of money to be successful. It varies all over the map. Some of these companies who don't need much money to get to profitability and have maybe sort of a more of a niche play, but can be a very attractive acquisition target, can get to a return with very little money. And so we show an example here, upper left-hand corner, a 20x multiple when they only raised like maybe $190,000. Now that's clearly the exception, but there are returns all over the place. And so, you know, there's the Ubers of the world that take a huge amount of money that may have a huge return. And there's companies that you might view as, using Juan's sports analogy, singles and doubles that can give you a nice return also. Questions, comments, Juan?
I have a question. Oh. Do
Go
you
ahead.
mind? So you were talking about risk assessment a second ago. Do you ever make investments based on the overall risk that your portfolio currently has? Like, for example, if you've invested in many risky companies, or at least companies that require a longer time frame to see the return, does that frame how, or like whether you'll make another investment in a company that has higher risk, or is it more off the basis of like, this company might be a greater risk and we might be having a lot of companies with higher risk, but we believe that it is a good company, so we'll invest in it anyway? Or will it be like, oh, we'll keep an eye on it, but we're going to look at like better, like, I guess, like lower capital, higher return investments?
Yeah, so I don't know any angel who's doing portfolio balancing basing on risk assessment, because we're anytime we invest, we think this company will be successful. And sometimes, you know, investors will use up all of their risk cash they want to invest for a while until there's an exit. But I don't think anyone tries to do a balance based on risk level. I don't know if anyone else has a different viewpoint on that. I'd love to hear that.
So, you know, my 2 cents there is that everything that we invest in, and this is why the previous chart talking about the portfolio size is so critical, everything we invest in is highly risky. So it's important to have enough companies in your portfolio to smooth the risk. The other thing is there's not enough data right now to properly assess the risk of each individual company when they come in for an application. And then lastly, and most importantly, is the risk changes dramatically in very short periods of time. So one company you might invest in today that you feel is not very risky could be very risky in a month, depending on what the market says. And the converse is also true. So the way to really address the risk question is through a portfolio approach.
Thank you, Juan.
Thank you.
So as an investor, you know, if you want to think about this top down, you may want to say, I want to put 95% of my money into stocks and bonds, public companies, have a wealth manager take care of that for me. I'm willing to put 5% of my assets into this asset class of angel investing. So then you decide, I'm going to reserve part of that 5% for follow-on investments. Maybe if we invested before, you'll invest again later. And the remainder of that dollar amount, you divide by 20 and say, okay, here's my average investment per company I'm willing to make as a first investment. So, you know, if you want to make 20 investments at 5K, that's $100,000. So it's just a way to kind of program your brain to think about this in a way that is sort of rational and get you to where you want to be in terms of building a portfolio.
Bob, the only thing I would add to that is the other way to think about it is also, if you want to get to, let's say, 20, you might say, well, I'm going to do it for 5 years and I'll do 4 investments a year. That's another kind of thing to think about.
Right. In our network, we've been typically investing in 6 or 7 companies per year. So if you invested in all of those, and I don't know anyone that does that, because we all have our personal preferences, you know, 4 years is a reasonable number, or 5 years is one suggested for getting that 20 portfolio companies. So all that said, you know, it's all about risk assessment, and, you know, no one knows, as Juan says, really what's going to happen in the future, but you can improve the odds by doing a more careful, thoughtful look at risk. And there are some individual investors who will say, I really like this team, I really like this product, I'm going to invest. And they may spend no more than 20 minutes thinking about it. That's your gut feeling approach. There are better ways to make a return than doing that. And that's, the more analysis you can do, the better off your returns will be, as shown on this next chart. So in this chart, all the blue stacks add up to 100%, and all the orange stacks add up to 100%. And so if you're if you're spending less than 10 hours in total, the odds of not making a good return goes up, as you can see in the graph. And more than 10 hours, you double your chance of a 5x return. And our network, when we collectively do a deal memo, probably spends, 80 hours collectively looking at a deal. And we do a lot of homework, a lot of thinking. So, okay, more than 10 hours is good. So go solo, plan to spend a week doing your homework, making phone calls, looking at stuff on the internet. If you're part of a network like ourselves, then the 80 hours we spend gets spread out to maybe 4 hours per person for 10 people, or some numbers like that. And also occasionally we get a really high quality deal memo, diligence report from another angel network who's done a good job. Then we can just put in even less work. So the message is, it helps to be part of a team, partly because you have different experiences in each member of the team. They can assess things you don't know much about better than you can, and it makes it less work and you get better returns. Questions, comments?
Will you discuss briefly how Southwest Angels approaches due diligence?
That is a great segue to the slide. Okay, we'll cover that in the rest of this presentation, basically. So the most important thing we're most sensitive to is the team. Do we believe this team has the capability of making this company work? On we've invested 24 times. We've had 2 failures so far. One of them was clearly a team issue, where we went in, there was a CEO, CTO, founder, and we talked to some earlier friends and family folks who said, we're not investing again with him leading the company. We had the discussion with the CEO. He agreed to step back just to the CTO role. He was using a outside consultant for marketing and sales, who became the CEO, but that transition never worked well. The new CEO never got to be CEO, and just the thing blew up. The team is so important. And of course, we care about 2 bottom lines. One is social impact, and the other is the business results. And so, at a high level, those are the 3 things we care about, and we'll talk a lot more about these. So, Heather, to answer your question more directly, after we've gone through a presentation cycle like we had last week, we had 3 companies presented. 2 of them had interest in moving forward. That's Herdsy and ATX LED. And we identify a lead for pulling together the deal memo. We have one for ATX LED. I'm still working on one for Herdsy. And we build out a due diligence team. We then take all the information from the company, including a supplemental information form we ask them to fill out after the pitch night. It gives us a lot more detail. And the team has an outline of a deal memo, and they go through working on that, being in conversation with the companies that work on that. And then that deal memo gets distributed to all the angels, and they can say, do I want to write a check or not? And so, what I've been doing a lot this week is I kind of humorously describe dialing for dialing with for Sonest, a company from the Q3. And as of today, we have 300,000 committed for Sonest. And here's my cat walking past. Yeah. Heather, did that answer your question, or does anyone else have questions on that?
When it comes to the team, do you do any due diligence? Background checks?
We certainly do interviews with people who know the CEO. We've not done a criminal background check. We could. We look at people's, life experience, and you can kind of get a sense of who they are from that.
We find, Heather, that the best information is from two different sources. One is the leadership team themselves, and then the references that they give us. And then when we can, when we can find them and time allows, is we look for other people in our networks and their network that we share together, and we get those sources as well. And that seems to give us a good picture as to who these folks are.
And sometimes during the deal memo development time, companies fall out. And often it's because we lose confidence in the CEO for some reason. Either the staff they've built around them is, somebody quiet. The staff they've built, their C-level folks, we say, really? You would choose that person to be your CFO or your CMO? Man, you don't have good judgment, Mr. C or Mrs. CEO, so we're passing. That's probably the most common failure in due diligence is team questions.
Hey, Bob, Dick again, maybe a dumb question or an off-base one, but do any of your investments deal with nonprofits that may have a social enterprise income producing, or are we purely in the for-profit environment here?
We're purely in the for-profit side.
Okay,
We've thought about adding some nonprofits to the mix, but as the board, we've decided we need to focus.
Thank you.
Good question.
Good question.
This is Chris. You mentioned about occasionally doing criminal background checks. Does anybody run this stuff through something like Westlaw and see whether or not there's other things that might pop up?
We have not, and that's a great suggestion. I'm making a note of that.
Defaults and other things that would not turn up in criminal.
Right, and so that would be good to know if there's a history of litigation, I guess, involving that person, right?
Yeah.
I would appreciate, I'll follow up with you and like to have a link to that source.
Bad news is I'm not a lawyer and I don't have access to it.
We do have some lawyers in our network, at least we did. Yeah, Jeff Toller still is. So, okay, job number one is looking at we're going to walk through the various risk assessment categories now in the deal memo. And, the team is job number one. You can get a sense for the person, emotional maturity. Do they appear transparent, open, humble? Sometimes you think the CEO has to be the Steve Jobs type, who's this overbearing, smarter than you kind of person. But, I think that people who are humble are actually most likely to learn from their customers, the marketplace, their employees, competitors, and continue to steer the company in the right direction. So, and they also, if they're humble, they probably have very good collaboration and communication skills. So that's really key. And, I've done a bunch of startups. I got better each time I did one because I learned what not to screw up next time as a startup CEO. So prior startup experience is good. And then please have domain knowledge in the market you're addressing. There's an awful lot of kids coming out of college, maybe with a computer science degree, and they want to go do a startup, and their life experience is the Austin Entertainment District, 6th Street, and maybe Instagram. And we say, how can you really understand what this industry you want to serve needs without some more experience? So, this is an area that we probably put the most emphasis on in terms of our deal memo. We talked to, as Juan was saying, all these various sources, and sometimes you can find secondary references that the CEO did not give you because they're likely to be more objective. I mean, I always give my friends out as my references. I guess you may do the same. And the good news is that some of our angels have a long experience in HR and outplacement and recruiting, and they have lots of ways to ask the right questions. Questions or comments?
Good question. If you see, for example, a startup doesn't have a CFO, or an important function within the organization, do you still, I mean, but you like the rest of the team, how do you go about it?
So often in these small teams of 2 to 5 people, they can't afford a CFO yet, but they have to have some access to someone who has CFO level experience on a fractional basis. Maybe one of the team members has enough experience to do that role. But, we recently had an experience with a company that applied to us, and their part-time CFO was clearly not suitable. We were extremely concerned, and the company agreed to hire a mutually agreeable CFO if we fund them, a part-time CFO. And so that's how we might deal with some of those situations.
I would just add that, it's one of the many things that we talk about when we talk about risk is what is the makeup of the team and where are the gaps in the team. But also having said that, as Bob said, some of the companies that we talk to are very, very early, and they might only have 2 people. And so, very important functions may not be covered yet. So another way we could do that is if we agree to do an investment, then one of our investors would take a place on the board and help them fill those spots and make sure that the people that they get are qualified.
Right. And one of the red flags I didn't mention is appropriate titles. Sometimes you'll have a young, inexperienced CEO who has all their college friends who've never really done much, don't have much industry experience. He makes them all C-levels, CMO, CFO, and none of them have the kind of experience that you would expect in a $20 to $40 million company for that title. And then we say, okay, this CEO doesn't really understand what's required of that type of title in terms of their ability to deliver, their functional results. And that's also can be a red flag. So impact, we care about impact, don't we? Yes. And so, the real simple test, first level test is the company's primary business mission impact? And, we had a company apply to us and they had a really cool recruiting tool. They had studied how Facebook and Google hired really top employees. And they built a platform that mimicked that kind of procedure. And they said, by the way, you can use this tool to hire diverse employees if you want to. So we're an impact company. And we said, no, you're not. Your primary mission is a general purpose recruiting tool, platform tool. And so, we had companies come to us and say, we have a new dating app for your phones where the first date's going to be volunteering at a nonprofit. And so, we are really doing good for the community by increasing involvement with volunteer hours and nonprofits. And we said, you're a dating company. So, and then sometimes we'll see companies who know that we care about impact will really spin their pitch deck hard for us. And we go check their webpage, make sure their homepage talks about their impact mission. Comments, questions?
Chris, this is at a primary stage. For the people that you have invested in, do you keep an impact scorecard?
We are getting better at doing that. We now require them to, when they apply, to give us quarterly reports. They don't always do that on their impact metrics, I should say. And we're getting working to be much more rigorous on that front. It's a hard thing to do because often these companies, they can describe what number of people they may be engaging with, but it's hard to know how they're really impacting those people's lives in a global sense. Causality versus correlation, all those kind of things are hard. So, we do the best we can, and yes.
So one of the things that happens in almost all startups is that they'll have a pivot of some sort, and so that's why it's really important to us that the primary mission statement speaks about impact, because even if they pivot, there's a good chance that they'll still be serving that impact mission. But as Bob said, that's not always the case, and this is an evolving field still, and we are getting better at measuring those things. But it's a reason to come to 203, which will be in a couple of weeks, and we talk about how we are getting better at that and some of the suggestions that we make to our companies and how they report back to us.
Yeah, and so after we've invested in a company and they're struggling from a business point of view, the question is, do they need to maybe nudge away from their impact mission in order to survive and to protect your investment? That's called mission creep, but sometimes that's kind of inevitable. So the other part of the impact story is my favorite word, efficacy. We all know, in the medical arena, they talk about new medical procedures or drugs and what the efficacy is in remediating the disease. And we ask them to, tell us as much as possible about why this really is going to make the world a better place. Sometimes, these teams are good-hearted and they say, wouldn't it be nice if we could do this thing? But we have no confidence that their nice thing, their nice intentions actually will improve people's lives. And so, partly, and then there's sort of the secondary effect, is this going to be a nice thing for people, or is this going to be really compelling in terms of their life trajectory? And are there other people trying to have the same impact that may be better at delivering an impact result using a different kind of approach? So, and please, we like companies better that are directly delivering the impact, as opposed to, we're going to help all the nonprofits raise money, so we're an impact company. That indirect kind of impact is really hard to measure and hard for us to get our heads around. Questions, comments? So as Juan mentioned, we have a whole webinar on social impact, measuring impact and results. So market validation. Wow, how important is this for a startup? It's extremely important. And we want to, whatever solution the company is delivering, whether it's a product or a service, we want to see that this is something that customers must have as opposed to a nice have. And if it's must have, do the customers have a budget to actually pay for this product or service? It's really easy for entrepreneurs to go in to a potential customer and say, all excited about their product offering, saying, here's what I'm doing. We're doing all these cool things. We're going to deliver these things for you. What do you think, Mr. Customer or Mrs. Customer? And the customer, being very polite, will say, that sounds very interesting. That might be interesting to us. Yeah, I'll be glad to answer questions. Keep me informed. At that point, confirmation bias can kick in, and the CEO says, I think they'll buy it. I think they'll buy it. But what they didn't understand is, this a big problem for the customer that the customer must solve, or is this a nice to have? And does the customer actually have a budget available to pay for it? Ideally, you go in like an enterprise sales model, you go into someone and they say, oh my gosh, if I use this, I can get a promotion. Or if I can't solve this problem, I'm gonna get fired and you can solve this problem for me. I mean, that is, and I have this budget for next year. I don't know how to spend it any better than spending it with you. That's the kind of affirmation that really can get investors excited. And are there enough people giving that kind of positive response to say there's a large enough market? Now, direct to consumer is a little harder because those decisions are much more subjective, maybe not as well thought through, more impulsive. But again, we spend a lot of time on this because we want to talk to customers or potential customers and hear them say, man, I have to have this. I don't know how to run my business without this solution here. And sometimes we get to try the product out. We had a company that had a medical device to help Parkinson's patients regain the use of conversation. And one of our angels had a brother who had Parkinson's. And we got to try it out and it worked, and we invested. Comments, questions? Go to market. So, these companies, as we saw earlier, can take, 5 years to get to an exit. And in those 5 years, they have to be successful in adding customers and adding revenue. And so what we like to see from these companies is some sort of, logical, well thought through plan about how they're going to build revenue, how they're going to engage with customers, how do they find the customers. When they talk about go-to-market strategy, the bad answer is, hey, as CEO, I have a lot of industry experience. I have this network of 20 people who are all interested in this. And the go-to-market statement kind of stops there. That's not a scalable business model. What does the organization need to be? Are you using direct sales force, sales partner channels? Are you going to be doing this all through SEO on the web? Tell us how it's going to work, how much it's going to cost you to get each customer on. And the good news on the due diligence side is that we have lots of former VP of sales in our Angel network, including Juan. And they can sniff out a story that doesn't make sense yet. Questions or comments? So product and technology validation. Yeah, if the product doesn't work, if the product doesn't meet the customer needs, there's a big hole here. And so we have invested maybe half the time with companies that don't yet have revenue, meaning the product's not in the marketplace yet. Usually that happens when there's such deep domain knowledge or such strong intellectual property or such strong confidence in the team that we know that they can make this thing work. But having a product that is out in the marketplace de-risks this a lot. If it's a software architecture, we have members of our team who can understand whether they can scale their software platform from 500 users to 100,000 users. If it's hardware, we have people on our team who can understand, do they really have a scalable manufacturing process? And so, we talk to the company, we have knowledgeable people from our side who can ask all the right questions. Sometimes for software companies, they're in this lean startup model where they say every 2 months we're going to release new features and kind of learn in real time from our customers. And what we like to see there is tight coupling of the design engineers with the marketplace and not have a product manager, shielding the engineers from the reality of the real world. So questions, comments? So do we like the team? Social impact's good. The go-to-market's good. The size of the market's good. Product technology works. What are the next questions? Competitive advantage. So, okay, it takes 5 to 7 years to get acquired. You have something, a really cool product. Customers saying, I've got to have this. I really need this. I'm willing to pay you. I have a budget. You have a competitive advantage over everyone else. And you go to market, especially if it's a software company. And then Google says, hey, look at this. This is really cool. I'll put 30 engineers on this and design my own version in the next 60 days. We want companies that have a story where we believe they can maintain a sustainable competitive advantage up until time they get acquired in 5 to 7 years or do an IPO. And so, there's different ways you can be successful. If you have a new class of social network, maybe you get critical mass and no one else in your sort of a social network niche can take that away from you. You may have a sales partner that will work exclusively with you who has a dominant position in the marketplace. Maybe you have some technology that you have IP around or other things. And so again, we have people who understand these market segments pretty well, who can have a sense of how hard it's going to be competitive. We also will look at their patents. It's pretty easy to look at the first independent claim of a patent and get a sense of how broad or narrow it is. And a very broad patent, it's very simple, is good. Apple got a patent saying using 2 fingers, you can zoom in and out of a map. That's a good patent, first claim. If first claim says if you do these 20 things, this is what we invented, and there's 20 pieces of that. Well, if someone only does 19 to 20, they don't infringe. So yes. Comments, questions? Financial validation. Okay, everyone's financial projections are wrong. We know that. In fact, the only thing that's probably accurate is largely accurate is last year's tax return. So, but it is important to see if the CEO, the CFO understand how these businesses work financially. Are they making the right kind of investments in the out years in marketing and sales and engineering? Sometimes companies will say, we'll invent this product and we don't need to do any more engineering work, and our net income will be 95% because it just works that way. Well, we understand at that point that their CFO, the CEO don't understand business models. And so we also look at the magnitude and the ramp of the revenue. We've had companies come in and say in 4 or 5 years we'll be a $5 billion revenue company, and they were a services company. And we said, I don't think so. And they may come in and say in 5 years we'll $300,000 in revenue. Well, that's a lifestyle company. It's not an investable company. And so if the revenue plan is based on the number of customers who really need to have this, and they can project that. We've talked to 100 customers, 5 say they have to have it, they're willing to pay, they have the budget to pay, and that 5% rate, when applied to the overall global market, gives us this kind of revenue. That's a good model. If they say we're going to take 1% of Google's revenue stream, that's a bad model. It's not credible. And again, a number of us have enough financial experience to kind of sniff through their financial models and get a sense for that. Questions, comments?
Hi, my name is
go ahead.
Jagada, and I have a question about this. So given that you primarily focus on the social impact sector, what is the typical ROI that you are expecting? Or, because I know with the impact sector, there's more of like the patient capital that kicks in as well. So how do you kind of validate financials with that lens?
Yeah, before you joined us, we had a little discussion of that, but the short answer is that
Sorry.
we're looking for companies that we think can actually work as a company and be acquired, because the IRR is so hard to calculate. And if we can identify, half the companies we invest in will fail, and if we could take that from half failing to a quarter failing with better risk assessment, our aggregate IRR will be higher. And so we don't think that it's concessionary to make impact investments. We think that you can make good returns in impact world. And there's data that supports that. Good question, though. Thank you.
Thank you.
Yeah, I would say that we don't think about patient capital. I think the only thing that's a little different in some of the companies that we invest in is a lot of the companies that we do invest in have the opportunity for grants and non-dilutive capital. And we think that reduces the risk for us, and it's exciting, and actually potentially makes our returns a little better.
Yeah, a lot of these companies are getting grants from the federal government, NIH or DOD or other places, Department of Energy. It allows them to really move their product closer to being market ready without taking equity investments.
Awesome, thank you.
So on investor return, as I said earlier, sometimes a small investment can get to a small company to an exit, and the ratio of investment dollars to return dollars is very attractive. Sometimes they need a lot of cash, and the theory then is that we're going to put in a small part of that cash, but the payout is going to be so large that we'll also make a good investment. So we look at what is the total requirements for cash over time, how's our ownership percentage going to play out, what's the size of the potential exit that's going to be there. And then we also want to see, for an investment we're making, that let me make my phone be quiet. Go to sleep. Power down. We also want to see, okay, you're raising company $500,000. We want to see not only how they're going to spend that, but what business results we're buying for the $500,000. Are you now going to have your first $1 million revenue year? Are you going to have your first patents approved? All those kind of things. So we want to know what the business results are going to be for this investment dollars. And we
So
say,
the other,
go ahead, Juan.
I was just going to add that the other thing we look at in terms of investor return validation is what is the realistic likelihood that a company in that space is going to get acquired? Meaning, how acquisitive are potential acquirers in that space in the last, few years, not too far back, but in the last 2 or 3 years, and what's the likelihood that those trends are either going to increase or decrease over the next 3 to 5 years? Those are also important things to think about.
That's exactly right. And, sometimes companies would come and say, well, Facebook or Google will buy us. And we say, okay, please give us examples for your market segment. Maybe it's, IT, healthcare IT, of Google making investments of companies that sort of your size and revenue levels that you anticipate being at. And if they can come back and say, here's 3 examples of Google acquisitions, we say, great. If they can't, then we say, you're just wishful thinking. And it's even better if they're already having discussions with some of these strategic acquirers in terms of maybe having some sales partnerships. Because now they've demonstrated they know how to start building those relationships even at the earliest stages of the company. So that's how we try to do our risk assessment, and any questions or comments on that at this point?
I have a
Question. Go ahead.
Yeah, a lot of this is obviously call intensive, and there's a process for getting to know management and just scheduling the calls. Is there any, and part of this is probably because it's so early stage that the materials aren't fully developed and it's messy in general, but is there any thinking behind standardizing some of this and finding other more efficient ways to gather information and absorb information that's different than call after call, I guess? Does that make sense?
Yeah, that makes a lot of sense. So most of the calls we do are on the CEO, and then also talking to potential customers. We may have industry experts that we are friends with that will call in to take a look at the technology and the competition. But it's a people business at this stage. It's not like a public company where you have good analytics you can use. And so it's all about gaining confidence in the team and their ability to deliver. So it's a pretty much, people intensive activity at this point.
We have streamlined the process actually quite a bit since the beginning. Bob's done a great job of creating documents and templates. But as Bob said, some of the questions at the heart of believing that this team can carry this mission for 5 to 7 years, it's just best done. It's actually best done face to face, but then second best, on a phone.
Yeah, in our down selection process, we get maybe 25 or 30 applicants per quarter, and we look at the written materials. They submitted a pitch deck, an application form, and we select 6 to give us a Zoom call. These Zoom calls last an hour and a half. The company pitches for 15 minutes, and we have a team of typically 10 experts, angels. They're all angels, or maybe a few guests, who will, ping them with questions for an hour and 15 minutes. And you can get a good sense as to, intuitive level about these companies in that hour and 15 minutes of hammering them with questions. And then 3 of those get to go in front of our pitch night. And then we say to the angels on pitch night, are any of you potentially interested in investing in any of these after the deal memo is done? And then if there's support for some of the companies, in this case, there were 2 from this last meeting, then we start the more rigorous 80 hours worth of work. And so there's a lot of pre-screening we use to try to be as efficient as possible to really get to top-notch companies even before we start the deal memo.
Gosh, thank you.
And what I always find so rewarding is that, you know, I'm an engineering guy. I spend a lot of time in semiconductor companies and marketing and business roles. So I understand, you know, technology, hardware companies well, and I understand fundraising because I raised a lot of money from VCs and angels. But I have huge holes in what I don't know. I've never been a sales VP. I've never, you know, done this or that. And our team of angels, we cover all the functional areas of a company really well. And we have good domain knowledge in most of the areas that we're getting applications in. So we have a pretty powerful team to, you know, assess these opportunities. So if you, other questions or comments? There was someone else who was trying to ask a question a moment ago, I think.
Oh,
Yes,
Chris.
hi.
Mariella.
Go ahead, Mariella.
Sure. Just wanted to know if you have a pre-fair valuation method that you use to assess the value of the companies. Because I know for startup stages, it's difficult sometimes considering the track record.
Right, and we cover some of this in our next webinar, the 202, but the short answer is that, you know, we do pattern matching. We know for a pre-revenue company that, you know, the money valuation should be maybe 2.5 to 3.5 ideally, unless there's something really compelling about the company that would drive the valuations higher. Maybe they have an amazing team, amazing IP, and then they might get a valuation that's twice those numbers I talked about, or 2.5 times those numbers. If they're in revenue, then, you know, seeing valuations, you know, in the $8 to $10 million range, you know, we get pretty comfortable with that. And it's just sort of like, here's how it works. You know, here's the pattern matching that we use. So we don't use a formal tool. Companies sometimes will try to use a formal tool and say, hey, we think we're valued at $23 million and they're pre-revenue. And we say, whatever tool you're using, you fed it bad data to give you that result.
Well, based on history, the type of companies that you've invested in, do they tend towards owning IP, software, versus things that are physically made and sold?
So, you know, last year, about half our investments were in clean tech, which generally involves some sort of hardware of some kind, whether it's solar hardware or other things. And the other half were generally in the healthcare area. Some were healthcare IT, some were, you know, some medical devices or some kind of other drugs. Yeah. So we will do some SaaS, software only companies if they have a strong impact mission, but it's not the only thing we do.
Hey, Bob, Dick, I had a couple of questions that they're kind of broad-based questions. First is, you may have shown this earlier, how many members are in the network right now?
As of this morning, 52. It was 51 yesterday.
Yeah, you did mention that, come to think of it. My second question, and this may be another dumb question, do you have any scenarios where donor advised funds participate? Or is that, you know, legally off limits because it's not investing in nonprofits?
So a donor advised fund, you know, there's the concept of PRI and MRI. And PRI is for a foundation, at least, you know, 5% of their foundation is granted, the other 95% is invested. That's the MRI portion. So a DAF could view this as part of their investment portfolio. And, you know, from the 95% of their basis that they're trying to grow the DAF with, could actually be invested in these as part of their basis.
I'm not sure I follow you.
Yeah, we should.
Is that a yes in certain situations? Donor advised funds.
Donor advised funds could decide to invest. Most of those donors, though, have very conservative investment strategies, and they're really thinking about donations and and having a very conservative investment strategy for the rest. If they'll have a more impact focused investment strategy for the rest of they're not donating, then they could invest, yes.
Well, I just think the concept of getting a return back to the fund replenishes a donor dollar is gone. An impact dollar can give a return that can be used later. So I was just curious if there were any examples of that. And it doesn't sound like it's very common.
I don't think we have any examples. We're certainly open to that. And there's no reason why I think legally they could not do that. But we do have we're a nonprofit. We do have some folks making their annual membership payments through their DAFs.
Dick, it's Chris. Something tells me that I might be wrong, but I think that whoever's managing the DAF would have to approve the investment through their investment team.
Well, the donor can advise.
It's be an option.
The donor may have someone managing it, and it may be a very conservative group, like a big, public company, Fidelity or someone who would make it hard. But donors can advise how those funds are used.
Yeah, I think the key is, or at least I'm with Schwab, and they'll get back to, are you receiving any immediate benefit back? Well, I'm not, my fund would be, but I wouldn't. So that's why I was curious whether that would violate any law regarding using donor advised funds in a for-profit scenario.
I might jump in.
I'm sorry.
There are a few examples I'm aware of that allow for this. The main one is called Impact Foundation. And so I don't know the exact legal design to allow for it. But I do know that certain groups out there have structured things in a way that allow for DAF dollars to flow into opportunities like this.
A DAF has the bulk of its money invested somewhere, right? And
correct.
The donor, if he's allowed by the fund rules to direct that investment dollars, can invest it anywhere he wants. Now, some big agencies like Schwab and Fidelity don't give you that flexibility, but there are some other DAF managers like Impact Assets that are probably more flexible.
Yeah.
Well, and honestly, this is Heather. Fidelity and Schwab may use a third-party conduit that helps the donor do that. So if Dick, you wanted to put money in Southwest Angel Group, we would probably need to set up a relationship with a third party that Fidelity is comfortable that they are a good custodian of that and that they'll do what they need to do because Fidelity doesn't want to manage it, or maybe Schwab manage it. So that's definitely a possibility.
Well, because I know that's some of the discussion we've had in Dallas about how we might draw more people into the network. So I was just curious to see what the obstacles were in approaching that, but it sounds like there's a path there. You just may have to jump through a few hoops.
I think so.
Yep.
So a couple of books here, which could be interesting. They're very accessible. You can find them on Amazon easily. We have this other class, Angel Investing 202, that talks about more about the investment instruments. What's the difference between convertible debt and safe notes and preferred equity? And how does valuations work? How does your percent ownership change over time? Or some of the key elements of that. So it's a little more technical than this one was. And the question we always ask at the end, we're always trying to make this better, this pitch. What did you like? What we could do better next time? Hearing no comments.
Chris, given the time frame of an hour, I think it's about right.
Thank you.
Yeah, Bob, I think it was a very informative, and what it did do for me, at least, it painted the borders of where Swan, it kind of put borders around Swan. Here's where we're at, here's where we're not. And I think that's helpful in terms of framing up the opportunities to affiliate that align with, again, what we're trying to do up in the Dallas area through SVP. So that was helpful for me.
We're certainly excited to have SVP as a partner here and to have Heather helping that conversation. We're so excited about that. And we think, jointly together, we can move forward on getting more dollars into this class of impact companies. which is just personally excites me. So thank you for your interest.
Yeah, this is Jagada, and I found, I joined late, I'm sorry about that, but I think the entire session was super useful for me. I'm the CEO of Impact Mapper. We are an impact-based company, and we tried to go down the fundraising path a year and a half back and failed. And it was interesting. It was almost validating to see the steps here, because we clearly know why we failed. And the fact that you highlighted your due diligence and stuff, this was something that I wish we'd known earlier. And now I'm kind of pivoting and helping companies on the other end, like with mentoring and advising companies that are going down the path to raise funds. And I think this is great. Thank you.
And I also would just add to that, even when we say no to a company, we try to give them as much constructive feedback as possible. And these are companies trying to do good, right? Let's help them be successful is our attitude. I think we're a very friendly angel network to companies. We're not, arrogant VC types.
You're a compassionate Shark Tank.
Yes, well said. Hey, I have another call.
With you then.
I had another call I was supposed to be on 2 minutes ago, so I'm going to bail out of this. And thank you for your time.
Thanks,
Thank you.
everyone.
Thank you.
Yes, thank you so much.
Thank you, Bob.
Great questions and comments. Thank you.